Retirement planning can get complicated as you begin to calculate how to have the best drawdown strategy for your particular situation. Generating cash flow from the various buckets of money you have: TFSAs, RSP accounts, employer sponsored pension plans, government benefits. And the goal is to maximize your cash flow while at the same time trying to maximize the terminal value of your estate, if that's something you want to do, to build buffer into your planning. And the only way you can do that is to harness the computational power of software applications. We do that all the time when we work with clients. And I had the privilege of interviewing Greg Leroux, who's a founder of Retirement Optimizer, an AI-driven computational program that helps advisors get down to the details of drawdown strategies to help clients maximize the use of their wealth to produce the income that they want through the retirement years. In this video, we'll talk about what prompted Greg to found the company, some of the logic or philosophy around how they've designed the software application, and then near the end of the interview, he actually goes through some real live examples of how to use the software application to provide solutions. Now, if you're close to retirement, make sure you subscribe so you don't miss future content. And as well, if you go to the show notes, there's a link back to our homepage where you can find out how you can start a conversation about retirement planning, and possibly maybe you want to harness the power of Retirement Optimizer to help you calculate your optimized drawdown strategy. So I think you'll enjoy this interview. Well, hi, everyone. Welcome to this edition of our podcast. And I'm really excited to have a guest speaker that we're going to be chatting with about some software applications that people can use for the retirement income planning. So our guest speaker is Greg Leroux. Greg, welcome to our podcast today.
Well, thanks, Shaun. It's great to be here.
Now, you are part of a software application or company that's put together this application called Retirement Optimizer. And so you are a co-founder of the firm?
Okay. Yeah, that's correct.
So we've begun using as a practice this particular software application on certain files as we've worked with clients to help them with their retirement income planning. So I thought it'd be a really good general interest discussion, tapping into the different themes of software applications and tools that people can use. This is probably more specifically a tool that an advisor can use. We use it. It's complementary to other applications we use, like Snap Projections. So I guess my first question for you is, what's kind of the backstory to Retirement Optimizer? How did that journey take place for you to be founding the company and developing an application specific to retirement income planning?
Well, thanks a lot, Shaun. The backstory sort of bookends with the backstory of my career in finance. So my educational background actually isn't in finance. I studied applied physics in school. And the typical career path for someone in applied physics used to be that you worked for Nortel or JDS when you graduated, and those industries had completely died by 2012 when I was getting out of school. But even when I was in school, I already started taking jobs, doing some contract work in data analysis for financial planning and wealth management. And one of the companies that I worked for, they originally had me doing some data analysis work on portfolio performance. CRM2 regulations had just come into effect. But they thought it would be really interesting to apply some advanced techniques to portfolio optimization, specifically decumulation optimization. Okay. So they looked at their client list. Most of their high net worth clients were either in retirement or pretty near retirement. Some of them were a little bit anxious about what their retirement would look like. And they wanted to see, is there a really efficient way to design a decumulation plan such that you minimize taxes and you maximize somebody's net worth?
Yeah, and I think that's a great segue. I mean, it's the core question of I've got different buckets. I might have some defined benefit pensions, some TFSAs, RSPs, eventually going to RIFs, maybe a LIRA account, different levels of taxable income coming in, and which bucket should I draw down on as I fund my retirement income. And so Retirement Optimizer is this software application that at a very granular level helps to provide guidance on the drawdown strategy between the various buckets or accounts. So with that being a lead in, maybe you could share with us, where do you see the best client applications for this modeling? And that may not be a precise enough question, but maybe you could come up with, where do you see it been very useful for people as they're planning to retirement? And a part of that question is the timing of it. When do you see the best sort of timelines, because you have sometimes talking to people who are 5 years away from retirement, 10 years away from retirement, some people who are just on the cusp of retirement. So what are the best applications?
That is an interesting question. I would say the best applications are people who are in or near retirement. So people who are already retired, absolutely, you can always change your strategy and maximize your efficiency once you're already retired. But even people who are 5, 10 years out of retirement, you have to make some assumptions about the future. So
Yeah.
how your assets are still going to be accumulating for a while. And with that information, you can have a pretty good guess of what they're going to be worth at retirement. And then once you're there, what the best plan to actually withdraw is going to
Yeah.
become.
Yeah, so that's a really good point. Like I think the two applications I've seen that have been ideal are, first of all, people who are pretty close to the retirement date and they really want to get specific about, okay, Shaun, what accounts do I draw down on in what order to fund this after-tax cash flow that I want? And I think the second application is, folks that might be already retired but they're relatively early in the journey and they haven't really done a detailed analysis. So they don't know what they don't know in terms of the drawdown strategy and the long-term potential costs to them based on their current strategy. Because a lot of people make decisions around retirement income planning with a lot of default sort of common practices, particularly when it comes to triggering government benefits or different drawdowns from different accounts. And I agree with you. I mean, once you get out 3, 4, 5 years, I think it's still valuable as a software application, but there are a lot of moving parts that can change over a 3 to 5 year period before you get there. So those two first applications, I think, are really useful. Um, when it comes to the retirement modeling, can you share a little bit about the logic, and I think we might show an example, but a little bit of the logic of the modeling, how it approaches the drawdown strategies for retirement?
Absolutely. But to do this, I basically just want to start with telling a little bit of a story about
Yeah,
someone who this actually applied to and give you an idea of what a retiree or a near retiree faces and how this actually solves their problem.
yeah,
So
perfect.
in this specific instance, it's a married couple. They don't have any fancy assets, no trusts, no corporate accounts, no non-reg assets, just a TFSA and RRSP. So something that's fully taxable, something that's fully non-taxable. They each have a TFSA and they each have an RRSP. That ends up not mattering too much because they ended up pension splitting, but in any case, the assets are relatively split. Now, they're forced to retire a little bit early. And this is something that some people may not realize. But if you're in your early 60s, or let's say in your late 50s, and you're in certain careers, if you lose your job, you might have to start thinking about retiring then. If, for example, you're a middle manager in a firm that gets merged into something else and you're laid off, middle management positions in your field of expertise might not be available. So your job prospects are transition careers for the last few years before retirement or just start planning now. The same thing is really true of people who work in technical industries. So these people were forced to retire a little bit earlier than they really wanted to. So close to their 60s. And they have a few decisions to make. Do they convert their RRSPs to RIFs right away? Do they withdraw from the RIF account with the understanding that it's got minimum withdrawals and then save the TFSA for later? Do they use the TFSA first and withdraw from the RIF later? And let's just imagine that they'd settled on a strategy. They also have to think about what age do they want to take CPP? What age do they want to take OAS? And it might be different ages between the two of them. And that's actually what Retirement Optimizer is for. So it turns out that you're leaving a lot of money on the table if you just do things based on rules of thumb. So the rule of thumb typically is if you want to project out to age 95, you want to delay taking CPP and OAS as long as possible. You want to use your registered assets first, which are fully taxable, and then you want to use your TFSA last. And to be fair to some financial planners out there and some other software providers, there's a little bit of flexibility in these rules of thumb. So some people will say, we'll try using the TFSAs first and see if that gets you a better result, or we'll try messing around with the ages at which you take benefits. But there truly is an answer that is better than all others. So in this specific case, it was a little counterintuitive. So taking OAS early and delaying CPP as long as possible turned out to be the optimal strategy because they were able to use some TFSA money, then minimize OAS clawbacks, but also qualify for GIS, and then mix together the TFSA and RRSP withdrawals actually in retirement and slide under marginal tax thresholds and make that last as long as possible. So if you just wanted to do this by hand, you would be forced to try various withdrawal orders as well as manually try different ages to take CPP and OAS. And even in this really simplistic case, you're still talking about 4 accounts and 4 different ages to take government benefits. The point of the software is to do this all for you automatically. So the computer can do millions of calculations. It can try millions of things and find the best one. And that's what this is really for. And that's how it gives people a real benefit by extending the number of years that they have a fully funded retirement, potentially increasing the amount of money they're capable of spending, and maximizing their net estate value at the end of the 35 or whatever number of years they projected.
Yeah, I think that's a really good sort of example using a case study. So you've got this counterintuitive solution around how to draw down incomes. And, the first thing that you're really emphasizing, it's individual. It's very customized and every client situation is unique. I guess
Well,
the
yeah,
other thing,
I just want to add to that a little bit. It is counterintuitive until you see the answer. So it's
yeah,
counterintuitive in the sense that you would not have really thought of this as the right strategy beforehand. But once you see the answer, you realize, okay, this is why it's useful.
yeah,
Because once you really look under the hood, the the key drivers of efficiency are twofold. They're minimizing taxes and maximizing government benefits. It's not intuitive how to do that, but there really is an answer to how to do that best.
yeah, perfect. Um, when you think about the different case studies out there, I'm making the assumption then that if I just had a client just now, I worked with the feds for many, many years, whole career, has a very good defined benefit pension plan, has their CPP, has their old age security. And I suspect that the clients that could most benefit from this exercise, and this would probably be the majority of people, because most people don't have gold-plated defined benefit, fully cost of living indexed superannuation plans. Most people have accounts where they may not get that, but they've got tons of flexibility. So the example you use, if you've got some non-reg, some TFSA values, some RSP accounts, you've got tremendous of flexibility in terms of how you can customize the drawdown sequence to do what you just said. How do we maximize government benefits and our cash flow over time?
Absolutely,
So
but I would have been surprised by this. This actually was counterintuitive to me. I made the assumption that people with defined benefit pensions would not care about this, but I forgot something that should be more obvious. Many people who have defined benefit pensions are married to partners who do not have defined benefit pensions. So even if you've got a client who has, a great pension, you still have to think intelligently about how to use their other assets. And Shaun, I realize that you're in Manitoba, so this may
yeah,
not quite apply to you and your clients as much as it does here. Retirement Optimizers based in Ontario. Many of our users are from the Greater Toronto area. I would guess that for the majority of them, real estate represents half or more of their net worth. Well, downsizing a property is a big thing that a lot of people will do, even if they have a defined benefit pension. Now, all of a sudden, they have a bunch of non-reg money or TFSA money, and they have to think about how to manage that once they downsize, or alternatively, get a HELOC to tap into their home equity without actually selling their home. So even in people's cases that are relatively simplistic, there's a lot of room for the computer to find a better strategy.
okay, perfect. Okay, so I made an assumption. It wasn't the right one. So that's great. So it has broad application, a lot of different scenario planning that can be taken a look at. Now, Greg, one of the questions that I had written down before our discussion was, is there a way that you can explain sort of the basic logic of this application? And then I think you're going to show us kind of at a high level, kind of a model on the screen that we can take a look at together. So any comments about the logic sequence of the software application?
Absolutely. So For those of you who are not computer nerds and didn't do an applied physics degree, the reason that this is possible now and it wasn't possible a few years ago is that computing power has really exploded with the advent of some NVIDIA GPUs. As well, the things that you can do with that computing power have gotten tremendously more complex with AI, neural networks, large language models. And the logic behind this is that because you have so much more computing power, so it can do so many more calculations per second, try so many more things, and because you can harness that power in a specific direction, you're able to cover all of the different possibilities for how someone could retire, how someone could draw down their assets. So it used to be that the problem was just too complex. So what people would do is they would sort of fudge the result, either by not using true tax rates and true tax calculations, but just approximating them, or by forcing the computer to use certain strategies. And to be clear, that is actually something the software can do as well, and it serves as a useful point of comparison. So if you want to show someone what their alternatives were, you can absolutely do that if they want a fixed withdrawal order. But what the software is doing is it's trying every possible combination of withdrawals or every different set of ages that you can take these benefits, and then finding the best one. The best one being described as the maximum net estate value at the end of the retirement. Some people ask why that's the objective function. Why isn't the objective function just to minimize taxes? Well, it's one of those counterintuitive things. But again, once you see a case study, it makes more sense as to why this is the case. Let's say the computer finds a means of retirement that's has so much extra efficiency that it enables you to stay retired for 5 more years. Well, you might end up paying more taxes, but the reason you paid more taxes was because you stayed retired longer and you had more money. So,
Yeah, good point.
you know, maximizing the net estate value, that's what we're really after. The other reason for that is that typically the rule of thumb in the industry is you want to project people's retirement out to beyond age 90. Usually it's 95, something like that. Well, there's advances in medicine. So things that might have killed you 20 years ago, you might actually be fine now. I mean, there's a friend of the family we have actually that unfortunately a couple of years ago suffered a heart attack, and you don't need quadruple bypass surgery anymore. He had 2 stents and 18 months later ran in a triathlon. So it might
Crazy.
be the case that like 95 might not be when you need to run out of money. You can project out that way, but if you have a high net estate value, meaning accounting for deferred taxes, you have the biggest bucket of remaining money. That means that if you outlive your projected retirement, you're in the best position to continue spending the way that you want to.
Yeah, so you're building in some margin for those contingencies. So again, we're trying to find the most tax effective way of generating the cash flow requirements while at the same time maximizing the estate value, right? And that provides these additional contingencies. It kind of gives you the best of both
Yes,
worlds.
with one little quibble with that statement. That's broadly true that tax efficiency is the way that the net estate value is maximized, but it's not the only way. So just being clever with the way that you draw government benefits, I
Right.
guess you could
Okay.
call that tax
Yeah.
efficiency, but it's slightly
Yeah.
different. And the reason I say that is because I don't want people to misunderstand. The software is not trying to make you pay less taxes in any given year. It is trying to maximize your tax efficiency over the entire 30 or 35 or 40 years that you're going to be retired. So using a tax efficient dollar today means it doesn't get to compound for later, but we want to take that into effect. So we do heavily care about the deferred taxes that you face all throughout your retirement and especially at the end of retirement.
So that's a really good point. And you may show this in the example, but the example will show the first year or the first 2 years drawdown strategy. So it goes through all the analysis and then gives you a breakdown about where to draw the money from. And I suspect that that really should be an application. Would you agree? Every year you should be updating the plan, looking at the drawdown strategy. It may not change, but it might be a good exercise to go through. Would you agree with that, or what's your feedback on that?
Absolutely, absolutely. And I want to talk about another sort of I guess you could call it a case study, but I think many of our users who are financial planners think in these terms. It's the idea of uh, continuous planning. You're looking over the plan for the 30, 35-year projection, but things will change year to year. And so what they really zero in on is the next 5 years.
Yeah.
So how much cash are you going to have to withdraw from each of your different accounts over the next 5 years? And I thought this was actually quite clever. Maybe that amount of cash that you're going to need for those 5 years in each of the accounts, that's put into something a little bit less volatile. So maybe that gets put into a mutual fund that's more of a bond fund that you're not too worried about a market correction with, or well, even Treasury accounts, not accounts, but Treasury bond ladders from the U.S. They've got the 3 month. Those actually might be useful because there could be a market correction. One happened in 2008 that was pretty brutal, but they typically don't last more than 3 years. It's rare that they last longer than 5 years. So just looking at, yes, every year, definitely look at the projection, but pay especially close attention to, what are the withdrawals that you want to make over the next 5 years?
Yeah, like I think that's a really good sort of piece that we need to focus in on, because you're able to drill down in a lot of precision how much money I'm taking out of each of my accounts. When I look at my TFSA or my RIF account or RSP account or non-reg, I can see on the schedules that the optimizer develops how much is coming out. Then I can go down into that account and go, okay, I'm going to raise X dollars, whether it's high yield savings, T-bills, short-term government bond portfolios, and have that money at the ready for at least 3 years worth of income payments to defend myself against that short-term volatility. So it's great because sometimes we have another software application that we use. It does give you some level of granular detail, but not quite as much as Retirement Optimizer. And so when you're thinking about your portfolio, and of course, a retirement portfolio looks way different than a pre-retirement portfolio. You're thinking through, how do I sort of piece into the portfolio these assets that are really have a call on them? Like we know that it's going to come out of the portfolio for cash flow, and Retirement Optimizer will give a lot of precision about what dollar amounts need to be allocated. And the reason that's important is you want sufficient safe harbor assets, but you do not want to be overweighted safe harbor, because that's going to be a cost long-term to you. So you want to balance those two things, right? Between, growth assets that might be very important in terms of purchasing power on your long-term assets and tax, while at the same time managing through potential market volatility. Anyway, sorry for
Well,
jumping
no,
in
no.
there.
I just want to speak to that point a little bit, because this is something that some people forget, and this is another one of those rules of thumb in the industry that maybe needs some re-examining. So, it's super important to be diversified, absolutely, but there is such a thing as being too cautious when you think that if you're projecting 30 years of retirement and you're just in cash for those 30 years, that growth is going to make a difference. Inflation has hopefully been tamed, but it was running as hot as 7% recently,
Yeah.
depending on what your specific basket of goods that you spend money on. Inflation that you have might not track the CPI. If you have to move, if you have to rent a new apartment, you're you're not getting the increase in rent that the CPI might imply. So
Yeah.
to that end, there is such a thing as overprotecting yourself by just being in cash or cash equivalents.
Yeah, no, exactly. So with that kind of overview on, a little bit of the logic, did you want to go into an example on the screen that we can look at together?
Absolutely, absolutely. So to be clear, this is not a real person or real couple in this case's portfolio, but it is related to different mixes of assets, but it's similar to what I was talking about earlier. I wanted to show you an example that is just a married couple with an RRSP and TFSA each. They both get some CPP. They've both been in the country for 40 years, so they qualify for full OAS, but nothing fancy. Because another thing that's a little bit counterintuitive, and I would have gotten this wrong, I would have assumed that optimization was only useful if you had complicated sets of accounts. And it was only through some test data and some trial and error that we discovered that optimization can be extremely useful to people who have normal, everyday median Joe, median Jane Canadian sets of accounts like RRSPs and TFSAs. In this specific instance, if they wanted to withdraw from their TFSA first and save their RRSPs for last and just use the earliest possible ages to take CPP and OAS, they run out of money 28 years into the 37 that they'd projected out. If we use the RRSP first, they get an extra year. So there actually is something to the idea that the withdrawal order does matter, even if you're not optimizing things, but you're still leaving a lot on the table. Alternatively, if we click on a button, so we didn't change any of their spending habits, we merely are optimizing the withdrawal drawdowns as well as the ages that they're taking government benefits. They get 7 extra years in retirement in this case. So it can have a profound impact even if you don't have specifically really complicated sets of retirement accounts. Now, in this case, they're still going to run out of money before they reach that magical age of 95 that we wanted to project out to. So what we can do in the software is also look at, okay, if we want to make sure that they have above 500,000 in their accounts at age 95, so they make it all 37 years that we're projecting in retirement, and they have a big cushion left over, how much do they have to change their spending? And in this instance, well, I guess it's going to be obvious to people in finance, but maybe not other people. You don't have to change your spending much. If something is compounding for 37 years, very small adjustments to the amount of money spent, in this case, just 5%, that's enough to add an extra year in retirement, so all 37 years, as well as leave them with an estate worth over $500,000. So what does this look like graphically? So if they're using their TFSA first, where their net estate value is in these columns and their income is in this line graph, they run out of money early. If we have them optimized, they get 7 extra years in retirement and their accounts last quite a bit longer. Nobody likes cutting their spending, but if you can show someone graphically, hey, a tiny reduction in the actual amount you're spending can have a big impact. They not only get the extra year in retirement, but their accounts have a lot more staying power. So if you're worried about longevity risk, if you're worried, am I going to be outliving the projection? Well, having a big cushion is definitely going to help alleviate some of those worries. So what's actually driving this? Well, the traditional approach of just spending your money in an ordered fashion, it leads to leaving a lot of money on the table tax-wise. So the RRSP is going to be fully taxable. They're going to have to spend an increasing amount of that through time after the TFSA is depleted. And CPP and OAS, they're just kicking in as early as possible. If we actually use the optimization, they're now not withdrawing money from a specific order. They're mixing together their TFSA withdrawals as well as their RRSP withdrawals. The older spouse is taking OAS at age 66 when the younger spouse is 64. That gives them access to OAS, but also GIS and a GIS allowance. So at age 66, when they take OAS, they are now using some TFSA money. And they do that until age 69 and 67, at which point they both take CPP. And from that point onward, they're mixing together. They're generating the cash flow they need from a mix of CPP, OAS, and their TFSA and RRSP. Actually, in some instances, they have so much money coming in from a TFSA, from their RRSP, that they have some extra where they're actually reinvesting in the TFSA. So shown in a table, without going too much into the nitty-gritty, Retirement Optimizer is extremely specific about the buckets of money to be withdrawn and how much from each bucket year by year to find out exactly what taxable amounts the client and their spouse need to have, what the total taxable is, and what their tax bill will be for that year. So this is really what drives the software. Lots of people are worried about this. Intelligent planning can really add value to their retirement. And intelligent planning can only really be done leveraging these extremely powerful computer algorithms where, Shaun, you could spend a year in front of a spreadsheet, and I'm not sure you would come up with specifically this set of numbers to minimize somebody's taxes over a 37-year time period.
Yeah, no, and what a great example, because you can see that sort of leveraging a little bit of efficiencies there at age, 66, 67, 68, where you're triggering some, or at least for 3 years of GIS. And for some folks, that would never be part of their thinking. Like they wouldn't even think in terms of GIS, right? They would, and yet there is that 3-year window that can be exploited in the context of the next 30 plus years in their planning. So it's a great application there. That's
Absolutely.
yeah.
Absolutely. Well, and in this specific case, just because I thought it was a useful thing to show, we're looking at a couple who they mostly intend to spend about 50,000 a year after taxes, and they have a really long retirement they're projecting, but they're not starting off with a crazy high net worth. There's
Yeah.
more money in the accounts because by net worth here we mean net estate value. So they're not starting off with a ton of assets. So leveraging CPP, OAS, and in this case, GIS intelligently has a huge impact on their longevity.
Yeah. Yeah. Okay. Great point.
Now, oh, one other thing I did want to mention, though, just really quickly, we don't have to go into it because people's eyes are going to glaze over, but we also do this for corporate accounts. So the federal government has recently changed how they treat retained earnings in a corporation, specifically those retained earnings if they're invested and they generate capital gains. And though those are more complicated, that actually does really lend itself to optimization. So should you be withdrawing from the corporate account first or last in that case? And what mix of withdrawals should you have between eligible dividends, ineligible dividends, and capital dividends? So absolutely, this optimization works on relatively straightforward cases, and we've shown one today just because that's something people can mostly wrap their head around. But the complexity really can scale, and the benefits of optimization are even greater in those cases.
Can you show that? Do you have the example there where it looks at common versus optimized? Is that in your worksheet
Yes,
there?
yes. So I just called the common one TFSA first here, but what I'm going to
Okay.
do is change it to look instead at the RRSP first, because that
Okay.
actually does end up being a little bit better. So I'll show that one as well. So
So just
these are
compare
originally
that.
just auto-named common, but
Yeah.
I've just shown them as RRSP first and TFSA first because I did want to show you that this is not only true because we're cherry picking the result. I'm going to get rid of the where they cut their spending as well, just so the graph's not too okay, just so the graph's not too busy and it doesn't get too difficult to read. Oop, let me uncheck that guy. Okay, so in this instance, using your RRSP first as opposed to the TFSA does actually improve the outcome, but mixing them together is much, much, much more powerful to the extent that it adds 7 years extra to the retirement longevity.
And you look at the summary chart, which is a great chart, I think, where you go through and compare optimal to, let's say RSP first. I'll use that example. So you can see in that summary, you've got the final net worth, the initial net worth, the sum of net income, all listed, and then of course the start dates for government benefits. And so it's a really good handy reference tool to see the long-term benefit of the two strategies. Yeah, like you said, it would take, well, I don't know how you do it in a regular software application. It's just crazy.
You would need a team of 100 interns just plugging away the
Yeah,
spreadsheet day and night for a year.
yeah. Um, Well, that's fantastic. I mean, obviously, anyone that's watching this podcast and going through Greg's explanation, this is very high level. There's obviously lots of detail behind the scenes in terms of really harnessing the horsepower of these applications. But it's a great example of what's out there. And so when we work with clients, we'll use a couple of different applications. We love Retirement Optimizer for when we get to the point in a base case model for retirement and we have a pretty good sense as to what the buckets are going to look like at the retirement date. Then what we do is we take Retirement Optimizer and plug in those numbers and begin modeling the drawdown strategy that makes the most sense for the family. So that's great. That's great, Greg. Thanks so much for going over that.
Absolutely. I just wanted to add one other thing. to anyone listening in the podcast, if you're a little bit familiar with finance, and if you're still watching if you're still watching the NHL on the Rogers app, or if you're watching on TV, you've probably seen some ads from Wealthsimple and Questrade, and they make a case. And let's just say, for argument's sake, that it's true. You don't really need a financial planner because they're charging fees, or maybe the mutual funds that you're buying through them are charging fees, and you can do way better with a robo-advisor. So statistically, that's not as true as they imply, but let's just say, for argument's sake, it is. That might be valid for a 25-year-old who is trying desperately to get their max RRSP return and then throw whatever's left that they've saved into their TFSA. But that really ceases to be true to someone who's in their 60s or in their 70s or even in their 50s who has to think about retirement, because this is something that a robo-advisor truly can't help you with. You absolutely need a financial planner. If you have an intelligently created plan, it can add a ton of value. And that's really what the software is for, to help leverage the value of intelligent financial planning so that a retiree can enjoy the fruits of their labors.
If your singular focus is how do I reduce the cost of my securities in my portfolio, okay, that's a discussion. But really, if what you're looking for is comprehensive planning, where if you do it well, it can essentially be an investment that could bear tens of thousands, hundreds of thousands of dollars of additional value over your life expectancy if you make the right decisions. And so these planning exercises are extremely helpful. Greg, thanks so much for making time today.
Thanks a lot for having me, Shaun.
Well, I hope you enjoyed that interview. Computational power using software applications is a critical part of retirement income planning. So make sure you subscribe so you don't miss future content that we're posting. And of course, if you want to discuss how you can get your own complimentary retirement snapshot and understand how a retirement optimizer can help you in your own retirement planning, visit our homepage, and there are links there to start a conversation. Anyway, you take care. Wishing you all the best in your own retirement income planning.